Okay, so hello, this is the inaugural economics coffee simulator. So the idea of this is that we'll be discussing a paper with its author. I haven't read the paper. I don't know anything about the paper. He's going to be telling us about us. Today we're joined by Gertjan Verdikt, who's going to be talking to us about his paper on the Spanish influenza. And thanks for joining us and tell us about the paper.
So thank you for having me. So the paper is titled Public Health Shocks and Product Pricing Behavior, because we were thinking we should do something along the lines of COVID to see what the actual real impact for consumers is. And we all like history, but history in this case could be a very interesting thing because there's a lot of research that shows that the influenza pandemic of 1918 in the US didn't coincide with the recession. So here we have a clear systematic public health shock, and we could actually try to learn how firms adapt to such a shock. And therefore, we look at life insurers because arguably to us, that is the most affected sector because you have clients who are dying, which is very unfortunate, but that means for life insurers, you have to pay out death benefits. But secondly, that also means that there's less income coming in. So this is also to us very interesting and very appealing because if you look at the influenza pandemic, there are a lot of younger people dying. So it's a relative similar situation, unfortunately, to Brazil now. We see a lot of news nowadays coming from Brazil that a lot of younger people are passing away. But what does that mean for life insurers? That means that there is going to be a huge mismatch between expected and actual payouts because the younger adults, luckily, are of lower risk for those life insurers.
But do you expect?
So therefore, we ask the question.
Sorry, do you expect that? Do you think there's going to be an increase in the demand for the product just because before people thought, "Hey, I'm 25, I'm invulnerable." I mean, once everything settles, there's probably going to be a higher sort of demand for the product, in general amongst those that survive. No.
No, that is very true. And that's something we see. Like in 1919, 1 year after the outbreak, you see a huge spike. But the interesting fact of that spike is that it isn't driven specifically by those younger adults. It's across the board similar. Because you have another paper who actually shows that the average age of a policyholder just increased by 6 months. So 37 on average before the outbreak and 37.5 after the outbreak. So therefore, we can say, or we can try to understand what is happening without having a huge impact in the composition of life insurers, because that is something we were afraid of as well. If there is any effect, maybe it's just the composition that changes. And there we're lucky to see that there's no real changes going on there.
I see. Perfect.
Now, what is the key in that literature is generally we think about price declines. So whenever a shock is happening, and most often it's a financial shock, think about the recession, the Great Recession, for instance, is a period which is highly studied in this literature. There we see a price decrease. Now, what do we find? We find actually a price increase. So firms that are more affected by the pandemic actually increase prices. And to us, that was a bit counterintuitive because you think if you are an affected life insurer, you actually want to have as lot as people as possible coming in, because there's still this idea of the law of large numbers. If you have a lot of policyholders, maybe you can spread risk way better.
Yeah.
But actually, we see that prices are going to increase if you're more affected by the pandemic.
So do you think this might point out to market power, that they're sort of using a bit of they have some level of market power and they're like, well, we lost a lot of money. We'll push against our, sort of ability to increase prices a little bit. So did they have actually market
So
power?
that was actually one of the things we looked at, because we were thinking maybe it's a competitive story. Now we can actually rule out competition because we actually specifically looked at market power, and there aren't that many changes in terms of market power before and after the outbreak of the flu. And why is that? One of the things you actually pointed out in the beginning, it was a huge demand. That means that in 1919, when there was the huge demand, there was also an increase in supply. There were more new life insurance companies starting across the US. That is a very interesting thing to see, that it spikes in 1919. So that actually trumps the entire competition story somewhat.
Yeah.
And also the quantitative evidence we have actually also points in the direction of not competition, maybe, and that's what we believe, it's more of a risk management type of story.
Yeah.
Like more affected life insurers maybe become more risk averse, and they want to increase prices, maybe drive away those people you do not want to have, maybe a type of adverse selection type of mechanism, or maybe just a risk management type of mechanism that is at play.
Well, but
Because
just
if you increase price, then you have more income coming in.
but just sort of, sort of very naive viewpoint, could just be that, they updated what their actuary tables were for how likely people were to die. And then the price is not really sort of reflecting, it's not like their markup that's increasing. It's just they thought, well, maybe people just die a lot more than we thought, so we just have to charge them more. Wouldn't that be the sort of baseline explanation?
No,
That it's
that's one of the that's one of the ideas we had as well. Now, one additional thing that points more towards the risk management explanation is if you look at geographical diversification, so the number of states that a specific insurer is active in,
yeah.
if that number increases, then you also see price increases. So then we believe that is more towards a risk management type of explanation. And also why we also believe it's more risk management is because if we look at where those life insurers actually have their business, we try to disentangle affected areas and non-affected areas. And what do we see? We see that more affected life insurers actually exit affected areas. So therefore, we also believe this can be a risk management type of explanation. Nevertheless, I agree with you to some extent that we don't believe this is causal. Maybe there are some other factors coming in. For instance, what you were referring to, maybe they're just updating their beliefs.
Right.
That is a possibility which we cannot test. However, with the evidence of the exiting an affected area, we believe that adds to our more risk management type story.
So just from
Because
a
that is an actual action.
yeah, finish the talk. Sorry, we have this lag of like five
No,
seconds,
I was
so we're
no, it's okay. I was just saying that's an actual action they can do
yeah.
in terms of if indeed their risk aversion increases, that's an actual firm action they can take to decrease risk to some extent.
Yeah. So I was just wondering, I just don't know how good, the US statistical data was in 1919, and especially sort of the contemporaneous. I mean, eventually, like at the next census or whatever, there's going to be like how many people died when. But I'm just wondering if, because of data unavailability, like even today, there's these things like how many people died of coronavirus, and it's still a range, and we don't depending on how it's counted.
Yeah.
So I was wondering if, different insurance companies, the only data they really knew were the claims of their own insured dying. Like then they really know this guy died on this day, and they filed a claim, which we eventually had to pay, or we didn't. So effectively, they're looking at different mortality data based on on what their insurance pool is, because that's the only data that they have sort of maybe month to month visibility on, versus the official data gets published, I don't know, with a 3-year lag or whatever. So their different behavior might reflect the fact that it's kind of like a multi-armed bandit. So like, oh, we had a lot of insured in Boston's, we got burned, pull out of Boston's. Some other company perhaps had a different demographic that wasn't as affected, even if it's the same sort of age group, but maybe they could move to the countryside or whatever, they were richer. And this could be sort of part of the explanations, that they're not looking at, they're not like all interpret, like giving different interpretations to the same data. They're actually like observing different data from their point of view. Do you think this might be the case?
So there is a very good point. So now I can tell you already, I've done some research in economic history, and in terms of data availability and the amount of data, this is the most amazing data set I've ever found.
Yeah.
Especially in terms of balance sheet information and what you're referring to, how many people die. The reason why people terminate contracts is also very detailed. We know if they die because they surrendered, lapsed, because of death. Those things we actually know. So we know the number of terminated contracts, but also the dollar value. Similarly, we know the value of newly issued insurance policy, the number. So we have a lot of data in that regard. Now, the data we use for mortality comes from Clay et al., which covers 2/3 of the US urban population. So if I recall correctly, it's about for 440 cities in the US. It is quite possible that there is some noise there.
Oh no, so
That
I'm
is
saying
something
like
we can't rule out.
I think your data is going to be great, because the period usually you can get good mortality data. But what I was wondering was whether the insurance companies would have had access at the time to such good data in real time, besides their own insurance pool. So we're,
I see.
because
Yeah.
like even today these things are published with a lag. I would imagine in 1919 or 1918 it would have been even worse, where how many people died by age group maybe a couple of years later, while
That's
instead.
actually not true in the terms of life insurers. But it's a very good point, and now I understand what you're saying. But what I found interesting for this period is there are a lot of magazines, newspapers, specifically targeted life insurers, published on a weekly basis. So
Okay.
there, on a weekly basis, you see how many people are dying, let's say, because of the war, because of the influenza, for
Okay.
other companies. So it may be true that you don't know the exact figures, but the trend is clear.
Okay.
You can really tell by looking at competitors what is happening. Let's say in Boston, if you're from San Francisco, you are
Right.
clearly aware of what is happening across the country,
Yeah.
because we use narrative evidence from 4 different newspapers, either monthly or on a weekly basis, specifically targeting insurance.
I see. Perfect. Okay. Yeah, no, I was just wondering, like, yeah, I actually bumped into one of these in one of those archive sites, like sort of Google Books or something. I think I saw one of those, like Life Insurers Weekly, or something like that, and half of it was ads and the
Yeah,
other half was like statistical extract. So right, that's a great
yeah,
point. So they had some
yeah.
level of common information. So do you want to
Yes,
move to
yes.
the graphs and explain what you doing with the graph and the table?
Yeah, maybe we can go to the table. I think the table
Perfect.
is more insightful in this regard, because
Okay.
that actually covers
Yes.
what we want to do. Because here actually we see what the main uh, comparisons and differences are within the greater literature.
Yes.
Because what we know so far is there is a general price decrease after an exogenous shock. That is something we know. We know asset growth and leverage are also driving these things. So what do we see in this table? Well, first, the post is the period after 1918. That's negative and statistically significant. So the first row. So that means
Sorry,
that
what
the
would be the title
overall
of the
trend
table?
for
Because it's the title of the table is cropped. So, like, what would be
the title of the table
is
is going to be product pricing behavior.
okay, so this is pricing of life insurance
So
products. Okay,
yeah,
perfect.
so the dependent variable is the price. Independent variable is then post, which is the period after the outbreak of the flu, which is 1918. During is 1918, 1919. After is 20, 21, and 22.
Yeah.
So therefore, on the top, we already see that there is a general price decrease. So the trend is negative. So that is actually the same as what we expected from other exogenous shocks like a recession. There we also see the general negative trend in prices.
Yeah.
Then I'm going to go through the controls just to highlight the similarities that we actually are talking about the same thing along different exogenous shocks.
Yes.
Asset growth is just the growth of your entire company. So the growth of your total assets.
Yeah.
There you see the exact same effect. It's positive. So a positive growth actually corresponds to price increases, which is similar to what you were referring to earlier. If you're growing, maybe you become have more power, and then you're more able to actually increase your prices.
And sorry,
Leverage is the other way around.
Just a question. What are interest rates doing in this period? Because maybe, it's a matter of like, they're giving me money for free. If my cost of capital is greater or lower, it would impact how much I'm willing to sort of discount insurance product because of this sort of float that they're giving me.
That is something I do not know on top of my head. What I can tell you already is that we adjust our prices for inflation.
Okay.
So we were looking at real prices, but it doesn't answer your question directly. But it's something I have to check. I don't know on top of my head. I think they're very volatile because we know inflation is also very volatile.
Yeah. So
So
if
I think
inflation is
probably it will be the
volatile, the
same.
real interest rates is going to be as well. Okay. Sorry.
Yeah.
Please continue.
No, so I was going to say, if we look at leverage, for instance, that is a negative relationship, which is similar to what we see for financial shocks. But what we find the most interesting line is actually line number 4, which is post times more affected.
Right.
And you are a more affected company if your mortality rate, and maybe I should say one, 2 sentences about this. So we know every life insurer has exposure in a specific state. We know how much exposure they have, so how much business they do. We know the mortality rate in those states, so we can calculate a weighted mortality rate for each life insurer according to their exposure. Let's say you are in Boston, Boston is heavily hit, then you should be penalized for that relative to a life insurer who is active in 50 states where only Boston is hit. So therefore, we have this weighted average mortality rate.
So I think just a suggestion. I think maybe it could be more exposed because more affected sounds like more people actually died.
Yeah, that is a very good idea. Yeah, that is actually the crux of the matter. It's more exposed.
Because I think it would be more intuitive, when people read the paper quickly and they look at, 2 tables and like, I think it would give them a clear idea.
That's yeah, because that is actually what we're trying to get. They're more exposed.
Yeah.
Okay. So you're more exposed if your mortality rate is above the industry average.
Yes.
Then you're in the treatment group, otherwise you're in the control group. And then we see that after the outbreak of the flu, actually prices are going to increase.
Yes.
And we see here a number of 0.062. What does that mean? That is 117 US dollars in 1917 dollars. Maybe that doesn't tell you much. I can tell you this is $2,500 in 2019. $2,500. That is a huge sum.
Yeah.
So therefore, we say it is not only statistically significant, but also economically significant.
Yeah. I think a
What we
car
also
was like
did is,
a
yeah,
car was
so
like
the average,
$250 something.
yeah, the average wage was about $3,000 in that time. So in 1917. So
Uh-huh.
$117 is a huge chunk out of the annual wage.
Yes.
But you can say already that sure, 1918, there's another major event going on, World War One. So World War One in this case doesn't really matter much because the US government was actually a huge underwriter of life insurance policies for veterans. Nevertheless, we still control for this by looking at the distance to military camps. So we match the minimum distance to a military camp with the headquarter base of the life insurer to get some sense of maybe a veteran goes to his local life insurer and not to the government. So to control for that, we also added the post time distance variable there, but it doesn't yield any significant result. But nevertheless, we wanted to be
Another concern would be that apparently,
thorough.
so there's some stories that the pandemic started from military camps. So another reason to have that in would be that it could be,
Yeah,
somehow a measure of exposure itself, and particularly of early exposure before there's any
indeed.
sort of knowledge that there's anything you should be worried about. So that's another way to justify inclusion. And we're typically
No, no,
this.
I totally agree.
Were the insurance companies typically kind of regional based, like so that was it typically there's one insurance company that's headquartered in Boston and tends to have most of its business in Boston, or were there a lot of sort of national companies?
So I can tell you that on average, 50% of business is in the headquarters state.
Okay.
So that's, to me, that's a lot.
Yeah.
And also, the average life insurer does business in 9 states.
Yeah.
So
Okay.
I think you can say it's a rather regional business.
Absolutely.
There's some who does business internationally, but there aren't that many. There are some who do business across the US, but mainly it's a very local
Yeah.
affair.
So remind me the difference between post and after.
So post means from 1918 onwards.
Yeah.
During is 1918, 1919, and after is 1920 to 1922. So to disentangle during the outbreak and just after the outbreak, because there were some rather local outbreaks still happening in 20, but
Yeah.
they were very minor. For instance, you had one in New York, but not in San Francisco.
So
So
sorry. So
it was more of a minor local.
sorry. So post
thing.
1918, during 1919, 1920, and after is
Post 1918, post is 1918 up to 1922.
okay. So
During is
post is right.
1918,
Yeah.
1919.
I see. So during is
Yeah.
disaggregating the post. So I would
Yes,
probably
indeed.
put in
Yeah.
parentheses the years.
Yeah, it makes total sense now that I'm
It's
actually talking about it
yeah,
like
no,
that.
I'm a big
Yeah.
fan of like tables that read like comic books, where it's like sort of everything is kind of like again, because a lot of people they just read, they look at the tables, figure out what it is, and then whatever they got, and whatever they didn't is sort of the author was not clear, because they didn't read the paper.
No, no, that
Okay.
makes total sense.
Okay,
Yeah.
so now I understand. So basically, yeah, you have these, and sorry, you mentioned this, but just remind me. So these were the log prices or the actual prices?
Yes.
Log.
Log real
Right.
price.
Okay,
Yeah.
so yeah. And
Yeah.
I think it would be interesting to have a column where you don't have the interaction effects as well, which is just showing like, if we didn't look at this, because you're showing both, so this is saying if you're more effective, you get on a larger increase, but if you're just in general, the prices went down. So it would be interesting to also have the number without the interaction effect, because that would just tell you what you were observing if you're not able to disaggregate things and you're just like, what are prices doing? and I'm guessing that the lowering would dominate. But it would be interesting to also see that as well. Okay, so yeah, so basically
That makes sense.
what you're saying is that overall the prices tended to decrease, but actually in the places that were most affected it increased. So it could be maybe a spatial spillover. So because, so basically the basic effect is that there's a crisis, and whenever there's a crisis, the price of life insurance decreases. But this is because of the economic crisis. And the economic crisis is generalized whether you got a lot of people dying or not, because just the country is sort of slowing down. Now, if you actually look at the places that were most affected, then actually there's an increase. And sorry, in these prices, they control for age of the insured. So this is like a basket of prices, or is it actually
No, the average. So we know
okay?
the total dollar value of new contracts and the number. So we
Okay.
divide both of them. So we have the average price.
But you
Therefore,
said it's
one of the
not a,
things I
yeah,
mentioned earlier,
sorry,
yes,
but
I
it's
was
not a
going to say
composition
probably the
effect.
same thing.
Yeah, tell me, yeah.
Yeah, I was going to say the exact same thing. It's not a composition effect because the age before and after is constant.
Okay, I see.
So, uh,
So one thing that would be interesting for me would be to look at, so this is like my standard sort of, like, I always want, to see this. I mean, I like seeing these things, is to look at like increasing rings of distance from the most affected areas. Because what, again, this is sort of a spillover story where, so having somebody die in a specific city is going to make life insurance more expensive in that city, and is making it less expensive in other cities because of these sort of spillovers, because it's reducing economic activity in the other city that wasn't affected. So if you had like
I
number
see.
of deaths within, you know 10 kilometers and 50 kilometers and 100 kilometers and 500 kilometers and 1,000 kilometers, and then you would get these coefficients that are initially very positive for very short distances, and then they're going to be sort of neutral at intermediate distances, and then they're going to be negative at other
I
distances
see.
because you're getting the economic negative effect. And then they're going to go to zero at really far away distances, because at some point you don't care. If you're in Seattle, you don't trade a lot with Miami anyway. So do it either with like geographic distance or like interstate trade flows. So I do something similar in my Neolithic paper, like in one of the later sections, where I'm using the distance. Like I'm showing that the effect of a specific factor, the coefficient changes predictably as you increase the distance. So this kind of gives you, it's kind of like an
That is
impulse
interesting.
response. And then you can say, maybe you can use geographic distance or distance along the highways, or distance, weighted by the trade between different states, if you have access to that for 1919, and say,
Yeah.
why is it, what were the channel of transmission? How is it that theft some other place are impacting the insurance prices in another place? And this is something like, I think it's always, whatever happens somewhere. So exploiting sort of the spatial component can help you. And I think you could also do that with the distance. If you had like, instead of distance, you had like discrete rings. So, you had like
Yes.
different
Yeah.
dummies of, you have a base within 10 miles, within 20 miles, within 50 miles, 100 miles, 200 miles. And like, is there specific distances in which, like, if it's that close, then you really get a bad effect, and if you don't, if it's further away, it goes to zero or something like that. Because
Yes.
the fact that you don't find, I mean, a simple way would be having the distance squared, but the fact that you don't find an effect, it could be that it's actually masking, two different effects at different distances. Maybe
I see your point. I like that a lot actually, because we just talked about regional variation and the number of states they're active in. So we can try to disentangle that distance to major outbreaks or minor outbreaks to a better extent.
Yeah.
I like that idea a lot.
Okay.
I'll have to think about it some more and read into it, but I like it. I like it a lot.
Absolutely. No, so is there something you wanted to add? Because I'm again, like I talk about this for an hour, but I'm trying to this format where people can sort of dip their toes into a paper, without investing the full hour. Is there something you'd like to add?
No,
That
I
we
think
left
I've
out?
said the most important stuff. I think I said the most important things here.
Okay, and
I
just
can talk about this for over an hour as well.
yes,
Like, I think that.
so I just wanted to ask, just because it helps people to understand, where do you think you're gonna submit this? Because it helps people understand, which outlets are sort of into which kind of paper.
So I think this is a rather difficult paper. We're not sure yet. So right now we have a short paper. So we try to be below 6,000 words, but focus on a general audience, because I
Yeah,
think that the topic itself is more of a general audience. So we were thinking American Economic Review Insights, Management Science has something related, Journal of Public Economics, one of those outlets. So more general type of outlets, because we're talking about product pricing and not so much focus on the historical patterns that are happening
yeah,
here. Because we do not try or do not focus on the history behind life insurers. We just take it as is. Hey, sure, it happens to be 1 century ago, but this
right.
could be COVID-19 as well.
Yeah, very good. Okay, yeah, that's important. So this is something that like a lot of people that do economic history, the advisors tell you that you don't if it's economic history, it doesn't have to go necessarily in an economic history journal. And in fact, there's many papers that are published. It's about finance, and you publish them in a finance journal, or there's a
Yeah,
demographic component. It's just because it's on a historical period, it doesn't mean it's not of interest to other fields that have looked at the same topic in the present or in the very recent past. And also, conversely, it's interesting because for economists, sort of history begins in like 1988, I guess would be sort of
uh,
anything that sort of happened before the fall of Wall of Berlin is now. I mean, it depends who you ask, but the history is
sure, but I get the point.
very recent for economists. Okay, so thank you so much, and I'm still gonna figure out where I'm gonna put this. It's probably gonna be on YouTube to begin with because I already have an account, and then I'll tag you, and then you can share it as well. And thank you so much, and see you around
Thank you
Twitter,
so much
and
for having me.
hopefully after all this
Thank
pandemic
you
is
so much. It
over,
was interesting.
we can meet at a conference in person. See you. Bye bye.
I sure hope so. Thank you.